I think it goes without saying that I've been more than critical of Intel's results over the past year, and a lot of it from a stock performance standpoint has been justified. The stock over the last year down nearly 34%. Look, even over the last 5 years, this stock has drastically underperformed not just the S&P 500, the broader stock market, but if you look at other chip stocks like Nvidia, AMD, even the chip makers like TSMC, this stock is dramatically underperforming, down 43%. You don't want me to show you Nvidia's and AMD's 5-year performance. It dwarfs this. So needless to say, I've been very critical of Intel, but every time we join you when this company reports their earnings like they did today, the Q1 numbers came across from Intel. Every time I join you here on the channel, it is a clean slate and it is a fresh start for Intel and its investors. And every time we look at this stock, we're looking at it from the potential of maybe starting an investment, because as you underperform over the last 5 years, as you underperform over the last 10 years, if you actually stretch out a max chart of this stock, it's actually done pretty well. And so we have to wonder, is Intel's worst days behind it and maybe better ones are coming? And I tell you what, to answer that question, the very, very first sign of it will actually show up in the price action. So you'll actually see from a technical perspective, you should actually see some evidence of that. We'll talk about this from a technical perspective, but even more importantly than that, it will show up in the financials, and we will go through the financials. We'll look at the Q1 numbers, the revenue, the cash flow, the balance sheet, the different business unit segments. Now, with a company struggling this much, it's very difficult comparing it year over year. The numbers are a disaster. So what I am going to see is we're going to pull up the Q4 numbers as well, and we'll go sequentially. We'll look quarter over quarter, see how the revenue is trending, see how the operating expenses and the operating profits are moving, and if they are starting to move in the right direction for Intel. Tell you what, this actually could end up being a fantastic investment, but you've got to get it right. You can't just jump in because the stock is underperformed. That is what they call a value trap and not a winning investment. Again, over the last year, stocks down 34%. The company came out with their Q1 earnings after the bell today. Revenue coming in at $11.7 billion. Folks, that was a decline of 36%. So some of you are going to say, well, look, the price to earnings ratio is ginormous on this one because the earnings have shriveled up. That is the definition of a value trap, because if you go look at some of my previous videos on Intel, there are going to be people in the comments being, well, the PE is only 14. Well, that is because you're basing it on forward estimates, which are going to be slammed to the floor. Look at the forward quarterly revenue estimates at Intel. They are down 72% over the last year. They are down 72% just over the last 6 months, as analysts have reined in the target. That is the number one mistake that I see from a lot of investors. They look at a PE ratio. They think all I have to do is look at this, and when it's low, I buy. When it's high, I sell. Absolutely not. Huge mistake. That is because these are forward revenue estimates, are just that. They are estimates. And when your business falls off a cliff, all of a sudden you go from a value stock to all of a sudden highly overvalued from a price to earnings perspective, but could create some great opportunity. Revenue coming in at a 36% decline year over year. The all important Q2 outlook also coming forward from Intel after hours. Revenue expected to become between $11.5 up to maybe $12.5 billion for the upcoming quarter. Some of you are very intelligently asking, well, what were the Q2 estimates for Intel? Right about $11.8 billion. The low end was very close to $11 billion. The high end close to $13 billion. So the company not guiding towards the high end estimate, but basically around the consensus estimate, which was sitting at about $11.79 billion. But again, what you have to understand is similar to the earnings at Intel, Analysts have been reining in the revenue estimates over the past 6 months to the tune of over 20% down. This graph shows you where the revenue estimates were in 2021, in 2022. And as the business continues to deteriorate, analysts keep reining in the target. And so you have to keep that in mind. When a company announces their earnings and they, quote, beat by $570 million, if you go based on the estimates from 2021 and 2022, this is missing by tens of billions of dollars potentially. Maybe not quite that high, but we're looking at multi-billion-dollar miss since nobody really anticipated this company's business falling off the map unless you knew where to look. And I knew where to look with this company, and I will keep my sources a secret until maybe we have a paid membership over on this program, because I think some of the information we're giving out here on the channel is worth paying for, to be honest with you. Now, gross margins in the most recent quarter, shriveling up faster than an old lady's face. Look at this, from 50.4 all the way down to 34.2. That is absolutely disgusting. When your revenue is down 36% and your gross margins are down at about the same clip, that is going to lead to some very ugly financials, and that is what we are going to see over here at Intel. Now, let me get back up to the profit and loss statement as we'll get to the rest of this form here in a moment. We had that $11.7 billion worth of revenue, and again, that was a 36% decline year over year. They're going to tell you they beat expectations by $570 million, but you know, like many intelligent investors, that was because the revenue estimates essentially fell off a cliff over the past 2 years for this company. Now, last year, we're not talking about like a long time ago, we're talking about 12 months ago, this company printed $18.4 billion to the revenue side, and we were posting videos here on the channel saying, it's probably going to get worse, and that's exactly what happened. Your cost of sales have not decreased fast enough over here, as your margins have just shriveled up from $9 billion down to 7.7. So your gross margin is more than cut in half. This is a disaster. When your revenue declines by about 36%, and look at your gross margins, they went from 9.4 all the way down to $4 billion. Folks, this company spends $4 billion and some change just on R&D. We haven't gone to marketing, selling, and general administratives. So 4.1 comes off the board off of $4 billion in gross profit. Yeah, we're losing money again this quarter. Your marketing costs come in at 1.3. I do like to see that came down. Now, some of you are very intelligently asking, yes, compared to last year, it's a disaster. PC demand, server demand, particularly for Intel's chips, has fallen off a cliff. Where is it compared to Q4? I think that's a better comparison. Q4 revenues were at $14 billion, and we're down here at 11.7. So we're not seeing any stabilization yet. Gross margins were $5.5 billion. Again, now down to 4. More importantly than that, it's really the cost controls, because we know this company's business has fallen off a cliff, and we understand a chip designer, chip maker, however you want to call Intel, they're actually a little bit of both. We understand that it takes years to develop a product, and this company has had product delays, products that flopped, products that just didn't meet the demand or the needs of the marketplace, and it's going to take a long time for this company to show a little bit of a recovery. And so what they have to do in the meantime is control cost. We see our R&D costs back in December, $4.5 billion. We are seeing that stabilize a little bit, down to 4.1. You're selling general administrative from 1.7 down to 1.3. If you're going to pull some encouraging signs off of these financials, that is probably where I would start. They had some restructuring cards that appeared in Q4. Those are a little bit less here. So $4 billion of gross margin, subtract all these operating expenses that total about $5.5 billion. Again, last year, far lower, $4.9 billion. Last quarter, they were sitting at $6.6 billion. So it's just a disaster. Your operating expenses have gone up by about $500 million. They are down quarter over quarter, but year over year, we'd like to see get south of $5 billion. Ideally, even less than that, but the company still has to spend money on this R&D to essentially play catch up to AMD at this point. You take $4 billion of gross margins, you spend $5.5 billion on expenses, and yeah, you're going to lose $1.5 billion. Last year, you made $4.3 billion, and we were negative on that company then. Now imagine how we feel. We lost $1.5 billion, and it is a little slight acceleration from what we saw a quarter ago where we lost $1.1 billion. You flow down to net income if you want, but it's not going to change the story over at this company. From a balance sheet perspective, it's still okay. You still have a fair amount of cash, $27 billion. When we get down to cash flow, we'll see how much we're burning through on a quarterly basis. Progress is starting to be made on the inventory side. We saw this in subsequent quarters where they just had all this inventory build. And so now, I mean, this is taking us from December. It's not really a year-over-year view on that inventory number, but you're not really seeing like this total depletion of inventory, which again is going to mean that those margins, all important margins, are not going to go anywhere. They just simply don't have pricing power. And look, this is not to just pick on Intel. If you look at NVIDIA's inventory, and I think when we look at NVIDIA's margins in about a month time, they're not going to be that great. When you look at AMD, probably in just a matter of days when they report their earnings, I don't think the margins are going to be that great. It's really kind of a comeback story. Can these companies hold on? Can they develop products over the next 6 to 12 months that deliver those margins when the demand comes back? It's still a question mark. I think with this company, the company does have some short-term debt and they have some long-term debt as well. That is a problem. We zoom back up here to the operating side. I said you didn't have to go far past operating income, but you can see interest and other net. It is down considerably year over year. So they've either done some refinancing there or they're certainly earning a little bit more interest on the cash that they have. Flowing down to the old cash flow statement. At Intel, you got your cash and cash equivalents sitting at 11.1. Last year, you were at 4.8, so that has improved. You pulled down a disastrous net income number of $2.8 billion. You were at $8 billion positive. This time last year, you get to add back in depreciation, stock-based compensation. How are they, compensating people over this company year over year with stock-based compensation? I'm joking a little bit, but you hope that they're able to turn things around, and they've done a lot of restructuring. They've gotten rid of some people that likely were responsible for some of this. And look, Intel could absolutely turn the corner. You come down to your operating cash flows, and it went from 5.9 to $1.8 billion. That is a massive disappointment. Company is still investing in its property, plant, and equipment, and they're likely going to have to accelerate that over the next couple of years as they are promising facilities here in the United States and around the world. You burn through about 8.5 there, and you come down here, and they issued $10.9 billion worth of debt, and that could be why they didn't have as much interest when it came to an operating side, as that's probably fresh debt that really hasn't matured a whole lot. That is also showing you why you have a massive acceleration in the cash year over year. All of it is coming, or most of it is coming from this issuance of the long-term debt. Now, they have slashed the dividend over at this company, but year over year, relatively flat to $1.5 billion. I actually think eliminating the dividend, while it would have a negative impact on the stock, probably a decent idea. I mean, you're only getting a 1.72% yield. But again, this is not like Disney, or this is not one of these companies that is in a really fast-moving industry. Okay, yes, the chip sector is a fast-moving industry, but from an R&D perspective, developing the chip, designing it, getting TMC or some foundry to make it for you, that's going to take a long time. Getting the foundry business built out here in the United States, that's going to take a long time. You need as much money and as much cash flow as you possibly can if you're Intel. And so I would actually respect them even more if they just straight eliminated this dividend or just lowered it. I could see keeping it because you want to maintain something, like take it down to 1 cent or something ridiculous like that. I think NVIDIA pays like a dividend that small. Now, coming down to the different segments, it's showing you that demand is falling off a cliff. From a desktop perspective, notebook. Now, some of this is sector demand related. Everybody upgraded during the 2020 cycle. Everybody got money from their employer. Everybody wanted to work from home, and I could understand. You wanted a new computer. You needed new capabilities. You were doing new things. You were working more in a remote environment, not on a workstation PC at an office. So I understand some of that is related. The other thing that I've been just hammering home here on the channel is AMD is eating this company's lunch in desktop and server and notebook. And I've had the fanboys clock in every single video that I've done and tried to explain, Sierra Rapids and Alpha this and all these different code names for products that just never delivered. Whereas AMD continues to deliver time and time again. You can look at the benchmarks, you can geek out on that stuff. Guys, far more important is just straight delivering the products on time to the customer, regardless of demand. AMD has done a 10 times better job of that compared to Intel, and it is chewing up market share. And also, obviously, the demand has waned a little bit. Certainly on the personal computing side, you went from 9.3 down to 5.7. I also wanted to show this to you sequentially, so quarter over quarter. Here's our client computing. They call it client or personal computing, whatever you want to call it. $6.6 billion. This is over a holiday period. And so, look, there's some of that buying and maybe a little bit of back to school as well. And so we're not expecting this Q1 to be as strong, but maybe a little bit of stabilization here. From 6.6 down to 5.7, not bad. Okay, data center year over year has fallen off a cliff from $6 billion down to $3.7 billion. Sequentially still getting its lunch absolutely stolen, punched, put in a locker by all the companies out there, particularly AMD. Went from $4.3 billion just a quarter ago down to $3.7 billion. Finally, you have network and edge. That went from $2 billion a quarter ago down to 1.5. It was $2.1 billion. Now, the rest of some of you are going to be like, oh, what about Mobileye? What about our Foundry service? Guys, these are rounding errors. $450 million, $118 million, $165 million. You could strip these out of the financials. That is like, what, $700 million? That is essentially a rounding error, okay? We're talking about $11 billion. They need to get their act together when it comes to server and particularly client computing. And when you look at AMD's products, not only that are out now, but into the pipeline, it's not going to be easy. It's not going to be easy. And I'm not just saying that like I'm some computer geek. I am saying that because I have sources that work at these companies. I have other people, actually content creators as well, that know people and know this business better than I am. And I am essentially relaying the information. I've been doing this actually for an entire year to you guys. This has been well telegraphed if you've known where to look for this information. And the information that I get, I actually pay for. I actually pay for these inside informations and this inside source. And that is why I've got to stop giving away these videos for free, honestly. But for now, you're getting this content for free, so enjoy it. From a technical perspective, we've had this green box. Look, the stock has gone sideways this is like 20 years. The stock has been sideways, down at 16, high end, you got up to 60. Most of the candles actually fit in about a 100% range from 16 up to, we'll call it 35. That is where the vast majority of these candles fit. You're sitting here at 28. So from a technical perspective, you'd actually want to get this one lower. That's where this green box comes into play. I'd like to get this one down here at 26. Insulates you a little bit, but just understand the timetable for this company's recovery is likely going to take a while. You also had this longer term uptrend, which started back in 2009. I'm on a weekly chart, so this normally looks like a daily chart. This is a weekly chart. This start essentially begins, my face is kind of covering it, in the 90s when, look, a lot of you guys were still little babies, including myself. We were making a series of higher highs, higher lows for well over a decade on this stock. That's why when these things break, and again, this doesn't just apply to Intel, any stock that you're looking at, even if it's like an ETF or the broader markets as well, when you get these breaks, this was the time to get out. In hindsight, obviously, everybody can be Monday morning quarterback, this type of thing. But right here at about $43, this was the time I could have said, I could see making one last gas. Like, this is a fake out. We're going to get back in here and resume that uptrend. That is possible. You still have a stop loss down here at probably 40, just very close underneath that. Then finally, when you broke this $35 level, which again was kind of more resistance than anything, once you broke below that, it was kind of look out below. The stock found footing at 25. We've met some resistance up here at 35. I don't have the after hours quote on here, but it looks like this one wants to get maybe back up to 31 in the after hours. I'm still not ready to give the all clear sign on this one yet, but I'm definitely like way less bearish because a lot of the air and a lot of the bad news is starting to be priced into this stock. It's going to take a while for the company to be able to put up positive numbers. If you start looking out at Wall Street estimates, we're expecting negative growth on this one for the next 2 consecutive quarters. And then we were somehow going to go to maybe flat sequential growth and then all of a sudden reaccelerate maybe to a double digit sometime in Q1 of next year. Depending on your kind of your macro thesis, that might not play out. If you think the recession isn't here already, I personally already think we've been in, we've been in a recession since March of 2020. It's been masked by stimulus and those types of things. And we're essentially in a recession now. The government just can manipulate these numbers because their boss is, wants to look good. So I guess it's conceivable that we're, kind of finding the bottom of this recession and then we kind of come out of it sometimes toward the back half of this year into next year. If you're not of a belief of that, thinking this company is going to accelerate to 24% revenue growth in the subsequent quarters, which again is still a revenue estimate that has come down 20% over the past 6 months by analysts. There's just still not enough here from a margin perspective, from a revenue perspective. And this is a falling knife as well. The stock is a falling knife. I don't want to try to catch it. I'd rather catch it when it resumes some kind of uptrend. And some might argue that that is what it's in the process of doing. It's trying to create some higher highs, higher lows, start to look something like this over the next couple of weeks. Look, quite frankly, it starts looking like NVIDIA over the past couple of weeks, or Meta, or maybe even Amazon or Apple, or you can even pull up like AMD. When the chart of Intel starts looking like this, that's when I want to step in here and maybe buy these pullbacks. I still think we're a little ways away from Intel. The chart isn't confirming that, but I actually could see that this sideways chop, this consolidation down here, is actually the bottom, and this stock starts to make a little bit of a recovery. But I don't want to be on here predicting that, because from a fundamental perspective, the slowness, if that's even a word, of the chip industry and the R&D and the development, it takes years. And so when you get behind, it can take a long time. Certainly anybody that has followed the history of AMD, that company almost went bankrupt and eventually found its footing. Not saying bankruptcy's on the doorstep for Intel, but they don't have that long to figure things out and start shipping products. I am less bearish on Intel I am today as I have been over the past 12 months, but I'm still not ready to invest. I think this will be a decent investment at some point, but I don't predict this stock outperforming the broader market over the next 12 months. So I'd rather have my money parked somewhere else. That was Intel Q1. Hopefully you guys have a wonderful day out there. We'll join you again tomorrow for the FANG Stock Recap Show. Until then, good luck with your investments.